we've been working on for a while. I think we've mentioned it in passing a couple times, and we're getting really close to finishing up, but I just want to demo this a little bit. So we are working up a website to hold all of the videos, all of the slides, all of the handouts, everything, and links to any other events and anything else that we're going to be doing regarding education. So we're really trying to make a nice central hub to where if you want to redirect somebody here, or you want to see what else we're doing, or how we can get more people in here. So this is activeretirementinvesting.com. We've been working on this in the background for a little while. You'll see a nice little homepage that just kind of talks about what we're doing. We'll have different links here that you can get to some different stuff. For now, the classes are still hosted on YouTube. We're working on a little bit of a section where you'll be able to see a breakout, and I'll give a demo of what that is working towards in a second, but you'll see a list of all the classes if you choose one of the seminars, and then it'll break out. You'll see the video, you'll see the description, you'll see the handouts for it. So if you miss a class, there will be a really good page for you to go to. So let me show you what that'll end up looking like. So you'll end up clicking up here in the corner, you'll choose which path you'll go down, and then this just has class 1 for now, but you're going to essentially break this out, and the video will be within this box. But you'll see which class it is, what we're talking about, little description, and then you'll get your handouts and resources with that. So that's what we're working towards. That's what we're hoping to create. You can always click here on recorded seminars, kicks you to the YouTube channel so you can watch whatever you miss. And then obviously if you want to get the book, you can get a free PDF copy of the book here. And if you want to reach out, let us know something, or if you want us to come by a community of yours or anything like that, you can fill out this form. So that's what we're working on. Super excited. And the more that that gets developed, we'll push that out to emails and stuff like that so that you guys can check that out. But stock market's up nicely today. Finally, for a little bit. So let's get started with what we're doing today. Today, we are going to start talking about what it's like and what you should be considering when you work with a professional. So I think this is pretty important because, there's a lot of different ways that you can work with a financial professional, whether it comes to an advisor or CPAs or attorneys. A lot of these principles you can use for many of those conversations, but obviously will be geared towards a financial advisor. So we're just going to talk about things that you might want to watch out for, things that you want to make sure you consider, and one of the most important parts to me, which is actually deriving where your value comes from. Because if you expect that your value is going to come from outpacing market returns, you're probably not the right person for an advisor anyway. That's not the service that you should look to receive. They're not going to do better. They're not going to be your hedge fund manager that makes you all the money in the world, but they're going to help you get through what your situation is and help you accomplish the goals that you're looking to accomplish. But before we get straight into that, we're going to do a high-level wrap-up of all the stuff that we've talked about, just any reminders, and it's a good opportunity for if there is something that you had questions about that we skipped past or you weren't here, maybe you can call out, or we can have a small discussion about that before we get to today's topic. So let's just go from the beginning. From the beginning, we started talking about a couple different goals that you could have, whether that's maximizing retirement income, reducing your income taxes, having your assets protected from inflation from different types of growth, funding child's education, growing your estate simply, financing travel and entertainment, distribution of assets to their right places, or protecting accumulated assets. So there's a lot of different things, a lot of different goals that you might have, a lot of different concerns that might be top of mind. So it's important to vocalize them, write them down, have a good list of what are the things you're trying to accomplish so that when you either do this yourself or you meet with somebody, there's a very clear path of action that we're trying to take, and there's not a lack of communication or a lack of service because there just wasn't the right conversation had. Then we also talked about how we break out our process, how we just kind of simplify it, because you can have the giant stack from a financial planning software. You can have somebody run you a bunch of simulations, but if it's too much for you, if it overwhelms you and you're not going to do it, what good was all that work anyway? So we like to keep it simple, break things out to things that are easy to follow, easy to manage, just to make sure that things get done and that you get to the place you want to go. So we talk about basic financial planning, making sure that you review everything that you've got going on right now and strategize for your future going forward. So this is looking at your cash flow. This is looking at your risk management. management, which is just code for insurance planning, looking at tax efficiency, making sure we're not giving the government huge tax-free or huge interest-free loans up until tax time. Although returns might feel good, really it's just your money not working for you for the whole year. Estate planning, making sure things go where they need to go, and then obviously your investment analysis to make sure that you're taking the right level of risk or achieving the right level of return for you. Then we move to the next investment portfolio. So building that portfolio to suit your goals and objectives. Really just the simple stuff, making sure that it fits your risk profile, that you're taking the right amount of risk to, one, accomplish what you want to accomplish, and two, keep you comfortable. Because if you're not comfortable and you make a change, you're not following the plan and you might not achieve the goal. So the ability to stay the course is almost as important as the course you're staying. So I would just always consider those as equally important. Then, of course, looking at the investments, analyzing what we've got, looking at what else is out there, what kind of products we want to use, and then building that portfolio. Then, of course, there's phase 3, looking back. After we've built our plan, after we've done everything that we need to do in order to create our future, making sure that we are sticking with it every single day, every month, every quarter, every year, whether that comes to investment monitoring, checking to see if we need to rebalance every once in a while, revising our plan to make sure it actually still does what we want it to do, or if we have a change of heart and we want to do something else, that we build that into the new plan. And then, of course, staying aware of your laws and regulations, of things happening, whether it's in the market, in the economy, in the tax code, all that sort of stuff. Not because we want to make changes every single day, but we want to be aware for when those big changes come around, that we know how to address them in our plan. So as we dive a little bit deeper into phase 1, we talked about our cash flow diagnostic, making sure that we list all of our current expenses and we look for our future expenses. Because if we don't have numbers, it's really hard to plan for it. If you don't expect much change, that's fine. Maybe you want to increase a spending budget for travel. Maybe you want to decrease a spending budget for something else. Or maybe you want to have more savings that you can pass towards a beneficiary, or whatever the case may be. Whether you think your budget is perfect or not, it's always good to just go back on it and be aware. Because if you're not aware, you could be throwing money away or have extra capital to deploy towards a goal that you think is really hard to achieve, but really just takes a little tiny tweak in your budget. So it's just good to go over these things regardless of how well you think you've got it down. Then obviously you're looking at your insurance, because if your assets get taken away from you from an insurable risk, that's just something we can avoid really easily with monthly premiums that are super, super happy to throw away to protect our assets and our success in the long term. Because one thing that my dad has always said to me is you always hope that insurance is the worst investment you ever made, but you still need to make it to protect you from the risks that these policies are meant to insure. So to make sure that, long-term care doesn't drag you all the way down, that medical expenses can be paid for, especially things like liability, whether somebody gets hurt on your home or whatever the case may be, making sure that your assets that are not protected by retirement plans are protected by insurance policies so that you don't lose that capital to deploy for whatever goals you want to achieve. Then, of course, the estate planning to make sure that things are going to go where you want them to go. So wills for small estates, or for that personal property, things you got around your home, any of those little things. Trusts, if you've got those big estates or specific instructions or just really specific things that you want to handle. Beneficiary designations, the easy way, making sure that your qualified plans, your IRA accounts, your insurance policies all have named beneficiaries, because if they don't, they will just get caught up by courts and probate and all this other ugly stuff. So no matter what you've got going on, whether you think your estate planning is perfect or not, double check those beneficiary designations, double check those transfer on death designations, just to make sure things go to the right places. Making sure that you've got your power of attorney set up so that if something happens, somebody can act on your behalf, both for the medical and for the financial and legal. Super important. Then, of course, walking through our tax diagnostic, just making sure that you take advantage of the investments, different types of investments, different types of accounts, different locations of accounts, and just making sure that we're not super inefficient. Most of your benefits are not going to come from this category, like I've talked about before. These are little tweaks you can make, little strategies that you can do, but this should really just, again, be a layer on top of the rest of the type of planning that we're doing, where we use this to scrutinize what we're doing for each other category. Then, of course, looking at our investments, making sure that things are suitable for our investment preferences, whether that's what type of investments you like and you will stay with, or if it's a moral obligation that you feel you have to invest in the right places. So those environmental, social, and governance issues that are becoming increasingly important for investors, to make sure that you put your money where your mouth is. And sophistication, to make sure that you actually understand what it is you're invested in. Even if you're working with an advisor, they should at least be able to get you on the same page of the basic reason why we're using the pieces that we're using. If you're at a complete loss to why you have a rollover IRA, that is kind of an issue of communication. If you're at a total loss for why you're in some sort of limited partnership and it's not a small part of your plan, or it just doesn't make sense, like, we need to understand why really well, or at least have confidence that the person you're talking to has got it back and forth. Risk tolerance, making sure that you're able to sit through those up and downs in the market. Obviously, that emotional tolerance is really, really, really important, because, like I keep harping on, the path that you're following, it's almost as important that you will just keep following it rather than it being the best thing. Because you might be able to get slightly better returns, but you might still be able to, accomplish your goal at a slightly lower level of return, a slightly lower level of risk, but you're much more likely to stick it through. So if you can take a whole lot of extra risk, but then you change your mind a quarter of the way through when a bad market hits and you handicap your returns by half, that's not going to help you nearly as much as taking a marginally lower level of return and being more comfortable as volatility hits. It's more about, is there a decent chance that this is going to work out, and is there a really strong chance that I'm going to sit through it the whole way? Then obviously, time of distribution is a huge impact on that. Longer time you got, more risk you can take. More liquidity needs you have, less risk you can take. Then those objectives, making sure we know what the purpose of the investment is. What are we trying to accomplish? If it's just a big pot of money and we're just trying to grow a little bit and have a little bit of it available, that's fine. Really easy to create portfolios for something like that. If we have specific needs for a certain beneficiary or a certain type of expense that certain kinds of accounts are better suited for, really good to know that. Good to know whether we're going for growth or we're going for yield. Do I want to be pulling cash flow out, or do I want to be letting it sit and grow over the long term? How much liquidity do I need? Am I going to be needing these assets soon? If I need to pull out assets in a year, it's unlikely I'm going to buy the S&P index. Probably going to go for short-term treasuries. So just simple things like that. Then we walk through our new portfolio construction using some terms that we like to come up with. So first of all, using time to select investments. These are things that I'm sure you've heard me repeat over and over again, but the more time we have, the more risk we can take, and the stronger our liquidity needs are, the less risk we can take. So we really just want to balance those two things together to create a good portfolio, and then put that layer of emotional tolerance on it as well. We've got all these types of risks that we want to make sure we either manage or diversify away from. You've got your systematic risks, which is really just, it's the risk of the system. It's just what it sounds like. It's the risk for being in there. So it's how much do you participate in that system is how much risk you're going to feel. So purchasing power, if your cash is just in cash and it's not earning anything, it's losing to inflation. Reinvestment rate, if you get out of a product and now you have to reinvest at a lower rate because you didn't lock it in, then that's just part of the rates in the market going down. Interest rate risk, if you hold something at 5% and now suddenly every other product is paying 10, your investment's going to be worth less because somebody needs to buy it from you to make it pay out the equivalency of 10%. Market risk, just the risk of being in the market. Usually we attribute this to the stock market, so you can just think of that as sort of stock risk. Exchange rate risk, so obviously your different countries, there will be differences in exchange rates depending on imports and exports and all other sorts of stuff that we're not experts on. So you can't diversify all of these things away, but you can manage them. So for example, for stock market risk, you can manage it by deciding how much of the stock market you're going to be in versus how much of cash you're going to be in versus how much of bonds you're going to be in. That's what asset allocation really helps us do. Same thing for interest rate risk. we can make sure that we're managing that by not having super long maturities in our bonds. If we have shorter maturities in our bonds, that risk isn't as prevalent. If we're okay taking that risk, longer term bonds can be okay. Their total returns are pretty good over the long term, but you just have to understand how that changes in the short term. And then obviously things like exchange rate risk and reinvestment rate risk, it's really just being diversified among different types of products, different types of countries, different types of interest rates, all sorts of different things. Then we've got the stuff we want to make sure we get rid of. And index funds help us a lot with all of this. Basically, you can think of that as the company-specific risk. You can remember one of those charts that I pulled up, which was a Morningstar chart that showed the difference between holding one stock all the way over to 1,000 stocks, as the market risk stayed the same, but the company risk dwindles to basically nothing as you hit 1,000 stocks, because each stock has its own unique risks, and not every stock is going to feel the same risks at the same time, so you just kind of get that nice balance. Then we go over to sort of what we call our lateral integration, which is just investing on a time frame. Remember, that's why we call it lateral, because it's a horizontal time frame. We're using time to help us determine what sort of things we're invested in. So we might have, over on our least aggressive things, money market funds and short-term treasuries and all that kind of stuff. We might have more balanced or value-focused things in the middle. And then we might have just total growth over on the other side. Most aggressive, growth-oriented, maybe concentrated investments, maybe even single stocks if you got them. Then, of course, we talk about our up and down diversification, which is what we call our vertical integration. So starting with our super, super low-cost index funds, bias towards the lowest cost to make sure we're not handing over those returns to a manager that's giving us the same returns as the market. And then maybe we get a little bit more specific with some passive funds in the middle, and then maybe add a little bit of managed funds on the top to get a little bit of diversification. Then, of course, we went through all the different things about risk and return metrics, from beta, which is our relative measurement of volatility compared to the stock market, alpha, which is basically how much more return we got for the relative level of risk that we're taking on. So if I take on half the risk, but I get the same return, I'm getting a decent amount of alpha because I didn't have to take as much risk and I still earned as much. So that's an extra amount of return. Then we have our R squared, which is basically just telling us how much of the return that I felt in this security or the portfolio was explained by some benchmark index that we compare to. Then we have our non-relative risk and return measurements, which don't require a benchmark to compare to. So we've got our mean return, which is just basically looking at all of the previous returns of the whole time period and then casting that forward with an expected value, which is no guarantee of performance. It's no guarantee of what direction it's going to go. It's just basically looking at the previous average and then casting that out into the future so that we have something to measure around. And then we have our standard deviation, which is looking at that mean return and thinking on a statistical basis, how far back and forth from that number are we likely to go? So if we're likely to return 10% in the S&P, but we've got a standard deviation of 15%, any year could be all the way up to 25% or down to negative 5% on like a 67% probability basis. And then we've got Sharpe ratio, which is basically just alpha if you use standard deviation to measure risk instead of beta. So it's not relative to anything. It's just simply looking at how much return am I getting compared to the level of risk on an absolute basis that I'm taking. Then we got our bond-related metrics, like our average effective maturity, which is all the maturity of all the bonds in the portfolio, considering anything that might shorten maturities or change things, change interest rates and all sorts of different things. And then we've got our average effective duration, which basically just takes the maturity and the interest rate you're earning on the bond, puts them together into one calculation. So oftentimes, I'm not considering maturity so much because duration is so much more important to me because of the fact that a higher interest rate effectively shortens the maturity length in a way. Still, you receive your principal at that end period, but you get paid back a little bit of it much faster if your interest rate is much higher. That's why I always like to think of duration as basically how long does it take for me to get paid back my investment, including the interest that I'm earning on it, which shortens that period by a little bit. Then we've got our credit rating, just basically telling you really strong credit ratings all the way at the top, super unlikely that they're going to default, all the way down to already in default. Everything above triple B, or everything triple B and above, is your investment grade. You can think of as kind of high quality. Everything below that being junk, or when they like to package it and make it sound nice for an investor, high yield. Sounds a little nicer. And then, of course, we've got some investment objectives that we looked at, all the way from current income, which is basically just trying to generate income right now today, to balanced, which is things that are a little bit more towards the income side but have a decent amount of growth, then to growth and income, which is a little bit more of growth with a little bit of income on that other side. And then, of course, our growth and maximum growth, which are just looking for capital appreciation. Then we move to the last phase, which is really just looking at our 3 key pieces of our plan and keeping them up to date on a regular basis. So first of all, that's portfolio monitoring, making sure that it serves our goals and objectives, cash needs and risk tolerance every single year. So making sure that we do everything on a daily basis to be aware of what's happening out in the world, be aware of the changes in the tax code, and be aware of what's happening to interest rates and just relative metrics overall. And then also making sure that you watch your fund updates and alerts so that you can know what kind of income you might be expecting, where your portfolio is sitting on a risk basis, what types of holdings are running, which ones are falling, and making sure that you just keep up your education. Love to listen to a good weekly podcast or a couple podcasts, maybe while you're having your coffee on a nice Sunday morning as you're anxiously awaiting what's going to happen on the market the next day. Then, of course, you go shopping when you feel like, there might be an opportunity to replace some holdings. Always like to find similar holdings, similar liquidity, but lower cost. If I can get rid of a couple basis points or several or tens of basis points and just not pay extra fees, all about it. The cheaper I can get it for the same exposure, that's great for me. So always just use this as an opportunity to bring the overall portfolio cost down. I'm not always trading monthly. I'm not always trading quarterly. Oftentimes trades will happen only annually, but it's good to just be ready for that when you feel like you want to make a trade or you want to rebalance something. I already know what's going to go in there. So it's always great to look at positions that are at a loss to replace them so that you can lower your fee as they're down, and then as that sector of the economy recovers, I get to feel more of that upside return because I'm not handing it over to high fees. And then check and see if there's old mutual funds that transition to ETFs, or, which is interesting, and I think I mentioned this at Sierra, I don't know if I mentioned it here yet, but it sounds like the SEC might start to get comfortable with the idea of certain funds having both mutual fund and ETF share classes. Now, I don't know exactly how that's going to work, but I know that there's some filings that are in progress to try and get towards that direction. So I'm curious if they would ever offer that swap, if the same fund has those 2 different share classes, if they would ever allow an exchange because it's a like-kind asset. Anyway, that's something interesting that I'm going to be keeping my eye on as things go forward. Then as we move to a quarterly basis, I just want to be really looking at those objectives, risk tolerance, income, risk-adjusted returns, fund expense. This is when I'm looking high level. So I'm going, okay, how is my portfolio really doing? Are we at the right place? Am I taking the right level of risk? Am I getting returns that make sense? Is my income happening in a way that's proper for me? Am I wanting this income? Is this income too heavily taxed? Is this income efficient? All those sorts of things to just understanding all of the ways that your portfolio works and making sure that it's working properly for you. And then as I look biannually, maybe I'm rebalancing, whether it's biannually or annually, making sure to look for those opportunities to trade back and forth and really just not necessarily trade for opportunities, but trade for your risk tolerance to make sure that you stay where you need to be and to pretty much just keep yourself at the right risk level so you don't overextend and now lose gains that you felt previously. And then annually make sure you review yourself. At some point it stops being about the portfolio and it starts being about you and whether this actually is continuing to work for you. So if something changed and you need to honor that and make sure that you look at your plan and see if something needs to be adjusted for that change. You might have a situation where maybe you have a new goal that you're trying to fund and now we need to change something up. You might have a situation where a goal that you thought you were going to fund is no longer present. So now we need to shift some priorities to just make sure that we understand, okay, Where is every dollar going, and how is it going there, and when is it happening? Then as we get to our estate planning maintenance, just to make sure that everything we have continues to serve, again, our goals and objectives, our needs, and any family situations. So we talked about all the different, sorts of different types of accounts that we could have. So there's just a quick look at those. Our individual transfer on death to make sure if you don't have a trust set up, or you just have some simple things you want to just make sure goes in the right place. A really easy, quick way to do that is with a transfer on death or a payable on death designation on your account. So that's abbreviated as either TOD or POD. So if you have an account that's, say, an individual transfer on death, when it's an individual account, just plainly an individual account, you'll usually see the abbreviation IND, but then if you see, if it's a transfer on death account, sometimes it'll be ITOD, and you'll see a difference in the actual abbreviations and registrations. So you can look at your different accounts, see what makes the most sense, and then obviously if you've got an account with a spouse that's under joint tenancy with rights of survivorship, and you're in California, pretty easy switch to change that to community property for the tax benefit of the entire basis stepping up when one spouse passes. Then, of course, we've got our couple different types of trusts, our revocable and our irrevocable, 4 different uses. Revocable is easier to change, so if you just want to do some organization, they're great. Irrevocable, a little bit more rigid, a little more difficult to change around, but also higher protections from creditors and all sorts of different things. Then we also gave out an estate planning checklist and went through one here as well. Again, you can find this on NerdWallet if you find it interesting. You just look up the estate planning checklist on NerdWallet and that'll be there. A lot of information that you could go into. Really just making sure that you inventory your assets, account for the needs, establish the directives, review the beneficiaries, note your state laws, and then check on if you need some professional help, and always look back to reassess. That's one thing that's always important with this, is keep looking back, keep looking back. Make sure that what you're doing keeps funding what you want to fund, keeps distributing where you want to distribute, keeps creating the situation and dream outcome that you want. Then we talked a bit about tax efficiency management. Always a fun conversation. I always learn a lot with this one. There's always new stuff in tax law. We talked about our different types of accounts, the different types of investments you could have in them, the location of those investments, so which types of accounts your investments are in, and what is most efficient. So one example that's interesting to think of, so when you think of things like corporate bonds or real estate investment trusts, that income, they might pay big dividends, but it will never be tax advantaged really in any way. It's always taxed at ordinary income. So the most tax efficient place for those returns to be is either in something like an IRA or a Roth IRA, because you're not going to get capital gains rates on the income. You're not going to get anything preferential. So you might as well have investments like that in a tax deferred account where you get to defer the taxes on those earnings and then pay them as they come out. So you allow them to compound rather than it comes out, you pay ordinary income taxes, then you reinvest over and over and over again and basically lose on the way. So just some interesting things to think about. But for the most part, you've got nice diversified portfolios with some qualified income, some non-qualified income. You should be okay across the board. Don't think about it too hard, but consider it a little bit. And then we'll get a little bit into those different accounts. So we've got our tax deferred and tax exempt accounts, and then our non-tax advantaged accounts at all, which is just basically everything else. I'm sure you're pretty familiar with most of these, then we've got things like our location of investments. So the other thing is also to make sure that you check on those tax forms. So you'll usually get a consolidated 1099. I know that's what our clearing firm sends out. That's also what my account at Schwab receives. So you just get one big PDF with all the information in there. But you will see the sections for 1099 div that shows you all your dividends. You'll see your 1099B that shows your capital gains and losses, your 1099 int, which shows your interest from cash and bonds and such, and your 1099 miscellaneous to wrap it up. So make sure you look at those 1099s, look at what sorts of dividends are ordinary versus what are qualified, so you can see what sorts of taxes you're paying on that income. Look at your capital gains distributions to see if that's something you're willing to sit through. Sometimes you'll just have big mutual funds you just don't want to sell because it's going to be more of a pain to pay the taxes on this giant sale of assets versus the little bits of distributions that happen every year. So really just consider what you're going for. And then looking at your preferential tax rates, understand what's going to be taxed at ordinary income, what's going to be taxed at tax preferred rates, and just see what's going to be the most efficient for you. Pretty much every time those tax preferred rates are what we want to get, but we don't always get to, have all of our dividends be qualified, and sometimes we have short-term capital gains. So use things like tax losses and whatever else you can to balance those things out and just make sure that your taxes are generally efficient. But don't freak out if you pay a little bit of ordinary income tax on dividends. Don't freak out if you have a little bit of non-governmental bond interest that you pay some taxes on, or you take a little tiny bit of short-term capital gains. Because at the end of the day, all of that means you made money. I think that's a net positive most of the time. So try and be efficient, but understand that it's still a good thing. So that's kind of wrapping up our little review of everything that we had going on through the class. So I just want to offer a moment of pause in case there's anything you guys want to ask before we talk about hiring and working with a professional. Yes.
I had long-term care like 50 years ago. Looked into it since, but back then, cost of it was just way high. It kept going up, and I worked for the state at that time, and we all said we can't afford this. So I don't have long-term care, and now my thing is, I'm gonna go. I hope it's fast.
Yeah.
I have any options.
Yeah, well, I mean, obviously, at some point it just ends up being where you'll have to think about how to self-insure, which is really just, what assets are going to get drawn from, or, what's going to pay for that. Do you have any insights you want to offer?
When you accumulate money on a tax deferred basis, we love it while we're doing it and getting the deductions, but we hate it when we have to pull it out and pay tax. So one thing mentally, if you have some old annuities that maybe you feel like I shouldn't have bought it, but if I pull it out, it's all taxable, put that aside for retirement plans. Then someday, if somebody is in long-term care, you can use some of that expense to be offset by pulling money out of this annuity or retirement plans. So yes, you have to be self-insured, but if you get some deductions, and they're probably going to go up, as the states and the federal government doesn't want to pay for your care, they'll give us more deductions. You can pull that money that's too much, too big, too taxable, and consider that part of your self-funded long-term care expense. The other thing is, if you have a spouse or an adult child dependent upon you, then we're worried about that. But if anybody here doesn't, an individual person, then you can use up your assets, the state will pay for it, and your beneficiaries are the only ones that get hurt. So we always joke that if you don't have the coverage and your beneficiaries think you should, then they can pay the premiums, because you're only pretty much protecting your beneficiaries. Now, if you have a partner, that's one thing, but if you have adult children, you're protecting them, and why should you pay all that kind of money? The other thing is, if you have an old annuity, which we don't like annuities, but if you have an old one, there are some policies that you can transfer the money on a non-taxable basis into a life insurance policy that has long-term care insurance. And then they take, let's say your 100,000, half of which would be taxable, you can transfer it to this life insurance long-term care policy. And then if you had to claim on it, they would use up your money for the first 2 years and maybe a little bit theirs. So an old annuity policy possibly, or retirement plans, consider that self-insurance. Or we were thinking about selling an inflatable barn so we could take out behind the barn.
Sell your house and just use that?
You could do a reverse
Yeah.
mortgage, yeah, or sell your house. Either way, that's a possibility too.
Yeah.
And if you have a one-story house with room for caretaker.
Yes.
I speak positively about care. Everybody's kind of like, I've had it for 20 years because my father died of ALS and last week. So I figured that you can die anytime with anything. So we both got it then. He is since deceased, but we both got it then, and I still have it. So let's just say at the point in time, I probably paid in about $25,000. Now, because of assisted living facility, et cetera, it's $8,000 to $10,000. So I basically have paid in 2.5 to 3 months over 20 years.
Wow.
If you look at it that way. Now, so I've been paying right now, I'll be 70 this year, at $250 a month. It has just gone up significantly, but only to $389, which I still consider. Good. So if you look at what it costs per month and will continue to go up, the amount you're paying, you have to kind of calculate that to see. So it's been a lot of money in, but, and I live alone. I am a widow, so it's important that I am able to finance them. So looking at it that way, I just wanted to give that a positive plug, because everybody's kind of like, long-term care, no.
Yeah.
It's not
Yeah.
necessarily that way, and I have, the benefits are immense.
Absolutely.
I see. So on, so on.
It's only when like CalPERS projected too much benefit and too low a premium. I have long-term care insurance. But it's only gonna pay half of the actual cost if it was significant. I had a stroke or a brain aneurysm. So if you have it, obviously, we get calls from clients, should I drop it? No, don't drop
Don't
it.
drop it.
Yeah. But the way that they make insurance money is to charge you a smaller amount over 40, 50 years, and that builds up. But like we say, the best that you can ever hope for with insurance was that it is the worst investment you made. Because if you never claim, that's okay, we're happy to give them the 25.
Exactly.
Mhm.
Exactly.
But that's,
Need it.
but if you were at the point where you couldn't quite afford the premiums, then I would say to heck with the kids. Tell them I'm gonna drop this unless you pay it, because I'm protecting your future.
And you also have a choice, you cannot continue to pay the premiums at a higher price, you then don't get higher benefits, which you do
Yeah.
the same, so you can have that kind of party.
You can shorten the, instead of a lifetime of benefits, you can shorten it to 5 or 2 years. Statistically, most people don't live that long. Or give up, and I think they took away the inflation rider. So it goes up, it just stays the same, but your investment's mine. So I would never give it up. But if you said I can't afford it, then we'll carve out a longer waiting period, a smaller protection period, get rid of this, keep that. But if you've got it, it's like life insurance. If you already have it, if you drop it down, then die, it was like, oh no, all for naught.
And it's not just for end of life, you have to be in for a month, year from now, and you take it out of that life too. So.
Yeah, Medicare will give you what, 80 days, right? Long-term care.
And it depends, Medicare also is for hospital, so it depends what kind of facility you're in, what covers which.
Yeah.
Yeah.
That's, just wanted to add that
Good.
opposite side.
Definitely.
Yeah, sure.
Oh, good.
Sorry.
No, that's okay. That's why I wanted to offer this moment. Okay, so now let's talk about doing it yourself.
Nash, before we move forward, I have a few questions from
Yeah.
the chat for the
Okay.
interview, if that's okay. This is the first question about taxes. If a stock held over a year is gifted to a charity, would you be taxed? And would the charity be taxed if they sold it?
So, no, both ways. Because one, and this is actually one of the great benefits. Now, the only thing that limits you is you won't be taxed on it, but there are percentage differences for how much of your income you can donate when it comes to cash versus securities. Cash, I think you can donate up to half of your adjusted gross income, and securities is only 30%. So that's something to think of. But you actually get to, and this is something that I did with a client a little bit ago, especially if it's long-term capital gains, you get to take the deduction for the entirety of the value of the position that you gift. So you get to deduct that whole thing. So we had it was like a $20,000 NVIDIA position. Obviously that thing had done pretty well over the last couple of years. And there was an opportunity to gift that to a donor advised fund. So we were able to gift that because it was long-term capital gains. She got to write off that whole amount, and that surpassed her standard deduction and all that wonderful stuff. So they will not pay taxes either because it's a nonprofit. That's kind of like the whole benefit for them is for them to not pay taxes on that stock. And then obviously because you're just giving it away, that's why you get to take that deduction, is because you just no longer have control of that asset anymore.
The next question is in regards to private equities. And the question is, how risky are private equities and would you recommend them?
Well, this kind of comes to that suitability question, because I'll just say very candidly, 99% of people that I have this conversation with are not sophisticated enough for private securities. Like, it's basically you're just taking a giant long shot because you either one have to be in the business of doing that. If you are in private equity or you're a venture capitalist, that's the thing that you're doing, and maybe that's like your suitable investment choice because that's your whole business model. But as your day-to-day investor, even if you're decently sophisticated and you know what you're doing in the stock market, those carry such an outweighed level of company risk because it's not even such a company that has, it could be a really decent company. It could be, not so decent, but it's just like when it's not liquid and you can't just buy and sell really easily, you get in and out of it. You can't use it to fund things very easily, depending on how well they let you redeem the shares. So you get into a conversation where it gets so much more complicated and it's so much more particular to whatever it is that you're talking about. So it's hard for me to recommend or not recommend a private security or a private equity because each one is going to be inherently wildly different. It's so much different than looking at just any stock and you can buy and sell it as you please. And it just gets to be a little bit more specific of a conversation. So it's hard for me to make any sort of statements on private equity because one, I don't deal with it. And two, it just ends up being really complicated.
I have one more question from the chat. This is directed towards Bill and Nash, and it has to do with indicators and what they mean. So the question is employment, inflation, and interest. What are they watching for on those indicators, and what do they tell us the market?
Well, I guess I haven't looked into what actually, was calculated for these. You got any insight for that?
Well, the biggest indicators right now is employment, right? It's up a little bit, so one side's arguing that that's a good one. The other one is interest rates, and they flatten, or people project that might be falling. So if you think they are, then it's a good idea to hold your intermediate term bonds or buy into the stock market. And if rates are falling, maybe real estate starts to move a little bit more there. And then the other indicator is what's going to happen with the tax policy, not to get political, but if they change the tax policy, is that going to be for the better or the worse? And that's something that we'll watch quite a bit, but then it's money supply, right?
Yeah.
And how many businesses are borrowing and not borrowing that.
Yeah, that's where interest rates really just go across everything is because it's how easy or difficult it is to get access to new money. So that's why we were seeing when interest rates got really low, tech companies were able to bubble really high because, the interest rates got really low, so they were able to take a lot of debt. But then as interest rates start to rise, it took a bit of a hit because, there's interest rates on those new loans that can't scale quite as hard. So a lot of companies that rely on debt to scale quickly will not be able to scale so fast in a high interest rate environment if their cash flow isn't incredible, in which case they could just afford it. But interest rates really just trickle to everything. It goes to real estate. It goes to how companies actually scale in the marketplace. It goes to consumer debt. So how much spending they can do based on what their interest rates are. Our interest rates on our credit cards right now are incredibly high. And so that just also can be a little bit of a damper on spending. It goes to everything. Interest rates are across all different parts of the market, all parts of the economy.
They would cause our national debt to go up, right? As T-bills mature and you get your cash and you want to buy new ones, they have to pay 1% more, 2% more, and that causes the debt to grow and grow and grow. But if we lower interest rates too low and too many people borrow money and buy stuff, then inflation goes up. So I wouldn't want the Fed's job.
Yeah, exactly. Okay, good. All right. Now let's get to the conversation for today, which is really just talking about whether you're going to do all of this yourself or if you're going to hire a professional. So there's three things that you want to keep in mind. Obviously, number one is the money. Everybody's going to always think about the money, whether you're happy paying it or you're unhappy paying it. You're always at least going to see that when you look at your statements or you look at the money you saved, whatever the case may be. So that's important. But then there's also time. So how much of your time do you want to end up spending on things like this? And we'll get into that conversation a little bit more in depth in a second. And then, of course, there's peace of mind. Some people feel way more confident having it in their hands, and that's great. Some people like to trust people who have been training for it for however long, or for my case, since birth. Some people like to hand that over. So it really just depends what makes you comfortable, what makes you feel confident about how you're going to get there, and how much you care about the money. So let's start talking about determining value. Because first of all of us as clients, even somebody like myself or whoever it might be, we have different needs. So we will have different ways of determining value that the advisor can bring to the table. So it's important to understand where that value comes from for you, because it may be, you may get the exact same service as the next person, but you might consider a portion of it to be much higher value than something else that the next person considers as higher value. So it's really unlikely that your advisor is going to outperform the S&P 500, especially if we account for management or planning fees. If you're paying 1% a year and they're invested in the S&P 500, you're not even going to get the same return because they're going to take 1% per year. And you just have to understand that that's going to be part of the transaction. So you're not going to pay for the returns of the S&P 500, because if you were, you would buy the Vanguard S&P 500 fund and pay 0.03% per year, and then you get roughly the same returns. But we have to look for other sources of value. So is that time saved? Is that emotional bandwidth? Is it too stressful to even take on this task? And this puts you at a better place. And as we know, mental health and stress directly impacts physical health. So is that a benefit for you? Or is it the strategic planning? Is there just so many little pieces and so many high-level things that you don't want to have to think about, or that you would trust somebody else to look and see the bigger picture? Or is it the experience? Is it something where maybe you have a couple years of learning, maybe you understand things enough, but you still want to, get that knowledge from somebody who's been in it for either decades or however long the case may be? Do you want to rely on their experience to help you, especially when it comes to the little things you don't think about, where somebody only sees because they've been doing it for a long time, and now this little situation comes up and they go, oh, wait, I have an idea. That's really valuable too. But at the end of the day, the most valuable resource that you have is your time. It's the one thing that none of us can ever make more of or get any of back. So it's important to understand, where do we want to put that time? And I'll always emphasize, if you want to put all your time into this, that's awesome, because you'll never run out of things to do, and you'll have just a huge to-do list every single day for the rest of your life. So the question is, how much of your precious time do you want to spend on this? If it's a ton, then that's great. You're a DIY type of person, and you'll save a ton of money on fees over the long term. A lot of advisors will charge a percentage of assets under management as an ongoing management fee. So it's common to see ranges all the way from 0.75% to 1.5%, maybe ratcheting down even further as the assets under management grow larger. And other advisors will charge flat fees. Maybe they'll charge a retainer, an hourly fee, or one-time fees on more of a project basis. So these can be way different depending on the level of service and the level of confidence in the advisor of how much they can charge you and that you'll stay. So it depends. But these are just median costs in the industry. This is what is kind of at the middle if you're looking around. A comprehensive financial plan oftentimes will cost about $2,400. A retainer fee for the year is usually about $5,700, and an hourly rate is about $230 an hour. So you can kind of see what it's like at the different types of compensation, what you might expect. There's nothing wrong with paying more for a premium service, or paying more for somebody that you trust, or whatever the case may be, but you just got to understand, where are you sort of in that area? Yes. The only difference is the percentage. It's just that you'll get the retainer fee and it'll be flat no matter what your assets are. So it'll just always be the same. But if you have a certain level of assets, that could be either more expensive or cheaper or whatever. But the thing about the assets under management fee is, it's kind of like the advisor is always incredibly interested in making sure that you either preserve or continue to grow your assets, because their compensation grows as your assets grow. So that's kind of just like, yeah, it's definitely an incentive for sure.
We make them your partner. And the interesting thing is, nobody tends to be sympathetic of us, but when the market tanks, their income goes down and your assets may drop, but you're not going to sell them. And then when they recover, you got a big discount. So they're going to be very attentive, and as your partner.
Exactly. And so what if you only want to spend some of your time? Well, maybe a specialized professional or a specialized group of professionals will be what you want. You might be obsessed with some particular areas of interest, and you might want to delegate some of those other areas of interest to other people so that you can keep your mental clarity and your focus for the other things that you're working on. And then you can focus your energy on what truly matters to you while not wasting on the things that don't inspire you. And if you only want to do a little bit, maybe you want to get a specialized team of professionals that can take most of the responsibility, that can take most of it away from you, so that you can have something like an estate planning professional, a CPA, whatever the case may be. Maybe you like the investments a lot. Maybe you love building the portfolio, but you hate taxes. Maybe you just really don't like filing tax returns. Your stuff's a little bit complicated. That's too much. You just want to focus on balanced portfolios, read the news for the different funds and whatever. Sure. Build out the rest of your team. And if you want to do nothing, well, you can get a comprehensive team of financial planning, investment, tax, insurance, and estate planning professionals, or an all-in-one solution, as many big firms have. And that will free you to do what you really want to do with this life. If none of this is interesting to you, if you're only here because you feel like you have to be, then maybe that's the opportunity to say, okay, let's let these people handle it. I trust this group of people, I have vetted them, whatever, and you do that, and then now you get to spend your time doing whatever it is you want to do. If all you want to do is travel, or all you want to do is visit your friends and your family and just do other things, that's where these professionals come into play. Now, the more time you buy back, the more you need to spend. That's how it's going to be. There's no way to get around that. The more of these things you offload, the more fees you're going to have to pay, because you're paying for more experience, you're paying for more professionals, and you're paying for more time. Now, it's important to know exactly what services you're looking for. So we'll go through a couple examples of some things you might get. First of all is risk-appropriate asset management, which is just where you're not expecting outperformance, but you're expecting reasonable returns that align with what you're trying to do. Somebody to build you an investment portfolio and manage it on a recurring basis, and just make sure that it's appropriate for you, it's taking on the right level of risk, that you're probably not going to lose all of your money in even a pretty dramatic market crash, that you're going to still be all right and fulfill your goals as things move forward. Maybe you're creating a strategic plan. Maybe you have a lot of things that you want to accomplish. Maybe you're considering Roth conversions, or you're considering this side of a stock, whatever the case may be. There's a lot of simulations that can be run with planning tools to help you figure out the best path forward and the most efficient path forward, different types of accounts, all that sorts of stuff. There's a lot of things that professionals can do to help you strategize moving forward. You might just need ongoing consultations. So if a comprehensive plan is not really what you're looking for, if you don't want that big stack of papers that says do this and this by this year, and do this and contribute that and invest here, if you want something a little bit more dynamic, a little bit more free-flowing and conversational, maybe just regular meetings with an advisor can provide fresh ideas and valuable second opinions as you navigate the changes, challenges, and opportunities that come up with your journey. So maybe that just means even something like, even lower on this page, like emotional biases, to make sure that you stay invested in the right places. Or just to make sure, like, I'm considering making this move. What's your opinions on that? How's that going to affect the rest of what I'm doing? How does that fit into the entire puzzle? That can be super valuable. And a lot of times these ongoing consultations will come with that investment management piece. That's a really good pairing, to sort of have your assets managed over here and then also have those regular conversations, and just to make sure that you're always on the same page, you're always going in the right direction. Pretty common that way. Then maybe if you're a DIY person, maybe it's good to have some snapshot evaluations. If you really like doing it yourself, but you just want to make sure that you got somebody to look over it and go, you're doing good, kid, you might go and hire an hour with a financial professional, or an estate planning attorney, or a CPA, or just somebody just to take a look. Maybe you feel very confident, but you just want to make sure, or maybe you missed something. Maybe there's some new regulation or some new opportunity that you didn't even think of. Good opportunity for something like this, for somebody to take a look at what you're doing and go, that right there could use a tiny little change, but otherwise you're great. That's always good. And then, like I mentioned, counseling for emotional biases. It's been shown from a study, I can't remember if it was Fidelity or who did this, but it was shown that clients tend to perform 3% better each year with an advisor versus without. Now, the reason has absolutely nothing to do with the actual investment strategy or having better stock picks or being in the right place at the right time, has nothing to do with that. The reason that it worked, the reason that this stat exists is because all the advisor did was sit down with them and say, we just stay the course and we just keep going. And they didn't lose 3% to panic decisions or changing their strategies during times like we just saw. I mean, it wasn't that long ago that the S&P was down 15% and now we're closer to maybe down 5. And so if you had made a giant change right at the bottom of that drop, but you still needed that growth long term, you just cut out like 10% of returns for really no reason. Now, if you were ready to lower risk and that was part of your plan, that's great, that's fine. Nothing bad about missing out those returns if you don't need them. But the reason that we get this stat is because they keep you on track, they keep you moving in the right direction, and they hold your hand as this market volatility hits and makes sure that you understand that what you're doing is the right thing and keeps you on the right track. Now, there's a couple different ways that you can receive advice and that you could pay for advice and services. So we'll go through a couple of the different compensation structures that you might have. When we talked about some average costs, all of that was for the fee-only advice model for not having commission products. So we're going to talk a little bit about each version of this a little bit more in depth. So first of all, we'll talk about commission. So although commissions are kind of a lingering piece of the past for the most part, depending on the industry, some products, particularly annuities and A-class mutual fund shares, or even sometimes ETFs, depending on the account type, will have an upfront fee that comes out of the initial principal investment. So it's not like you pay an extra amount and then it gets invested. You give them $1,000 and 5% will come out of that investment. So now you've invested 950. So that return number is based on the reduced principal from the commissions that came out of it. Commissions tend to incentivize certain products being sold. So while advisors have to follow fiduciary responsibilities, commissions can bias choices a little bit. And I'll put an example in front of you. If I was creating an investment portfolio and I had all of these different products to choose from, and let's just say I'm picking some growth fund, I want to pick a growth mutual fund, and I've got 3 options. And they all do approximately the same thing. They all have approximately similar annual returns. They all have approximately similar risk, approximately similar everything. One pays 3, one pays 5, and one pays 7% for my commission. How do you really know that they're going to pick the lowest commission for you? If all of them serve relatively the same purpose, and that little number you may not notice so much and won't even question, how do you know? How do you know that they're not picking the higher commission product if all of them do relatively the same thing? It's just little minutiae like that that are really important to understand. It's really important to kind of just get that idea of how are you being compensated and how much. Now, one thing that was also interesting, oh, yes, question. Mm-hmm.
Or something, and if you hold it for so long, then it converts.
Yes.
Getting charged a greater fee or something less than that one, so that eventually they're getting the money out of you. Is that still a commission that's going to?
Yes, that'll still be a commission that either both goes to like the mutual fund company and the broker who sold it to you and all that other sorts of stuff. So you've got things like
Oh, yeah.
right. Yeah, exactly.
Yeah, you're paying an extra 1% for like 89 years, when normally it would be 4 or 5. If they said, we're not gonna charge a commission up front, we're just gonna take 1% a year, then it would stop at 4 or 5 years, and then you go back to the lower expense ratio. But they ran those up to like 8 years, so the broker got 4 or 5%. They kept paying themselves for an extra 4 or 5 years. Then they converted to A shares, and then they're gonna talk about trail. So
Well, we can talk about that now.
some of those A share that trail also hidden fee, but that was fine in the years when people didn't know about Vanguard. They didn't go to the brokerage account. They just stayed home and waited for the broker to show up at your house on Saturday. So they had to pay them something up front. That's how brokers were paid. And then people realized, I don't want to pay any better English. I don't want to pay no commissions. How's that? Up front. So then they came up with the B shares where you didn't see it. You got the full value of the share, but then every year for 8 years, you have an extra 1% fees, so they could pay the broker up front. And then they went to C shares, which were fine. It was an ongoing extra half or 1%. But then they have other fees and penalties, so.
Yeah, so that's something interesting. Like even if you're looking at commission products, if that's the route you decide to go, there's differences in the math between within the basket of commission products. And oftentimes the things that feel the worst, paying the most up front, mathematically tends to be the thing that works out the best because you don't have these extended periods of elevated fees. They're just like, here's what it is, and then it goes from there. So if you're in the commission space, oftentimes those upfronts end up being mathematically better if you've got the time to support it.
If you had a grandson or somebody that wanted to sell you an American Funds A share and you just wanted to help them out, if you invest in that family, you pay 4% upfront. If you stay with that family for 20 years, it's gonna dilute way down to where almost you didn't pay anything. But now you gotta stay with American Funds. You can't go to another company all over again. So unless you're trying to help somebody out or there's an unusual circumstance, we'd rather see a Vanguard, Fidelity, Schwab, no load. And whether you manage it yourself, or if you have to be, there should be values that Nash is talking about. And the problem with selling an A share is that broker now has to start over with new clients. They don't have time to talk to you. They already got paid.
Yeah.
This is just from Zoom. If you could just summarize the question just asked with this answer.
Oh, sure. Okay, so they were basically asking about a question about the different types of shares. So we've got our A shares, B shares, and C shares, where we had our A shares of mutual funds that charge the upfront commission, and then we had our B shares, which make it look like you don't pay any commission, but then they'll spread it over a couple years, higher management fees, and then you'll also have your C shares, which just charge the higher management fee. And that was kind of like the birth of the AUM model, kind of in a way, because it was a similar sort of model, but it was tied to the product. And then we just kind of talked about how the math usually shakes out to those upfront commissions a little bit better. But if there's any other questions, feel free to let me know. So always make sure you ask your financial professional how they're being compensated and if they have conflicts of interest while serving you. They have to disclose and address those conflicts as they act as your fiduciary. Now, something that's interesting that I read about when I was doing the last class at Sierra, it was something along the lines of, I forget who made the determination, but somebody was saying agents of broker-dealers should not be able to call themselves advisors because they're selling products. They're not selling services, they're selling products. So there was somebody that was saying, no. These agents of broker-dealers, they should just call themselves brokers. They should not call themselves advisors because they're not actually all the time acting in the best interest of the client because they're selling for a commission. So I'm interested to see how that shakes out and see if a whole bunch of professionals now suddenly have to change all their business cards because they can't call themselves advisors anymore. So that'll be a fun one. Now, here's a couple of those other ones that we talked about earlier, the other way that things can be charged. So people can charge a fee for service, whether it's hourly or retainer or whatever the case may be. They might prefer to charge for each service provided using flat fees, hourly fees, or a simple retainer fee that can be charged anywhere from monthly, quarterly, annually, or as needed. Then you might do one-time plans if there's complicated planning needs, or if somebody in sort of earlier life just wants to get a set of guardrails to follow for the next decade or two, one-time plans can be pretty good. So something like a one-time plan for maybe a beneficiary or something like that can be a nice gift where you go, listen, I'm just going to have you sit down and I'm just going to give you a nice guide of what you can do to get to where you want to go. So that's always nice. But be aware that there might be additional fees when the plan needs to be changed or reviewed. Sometimes people will do reviews for free on a plan that was already done, but sometimes they might charge you a little bit extra to do that meeting again or charge you an hourly fee. It just totally depends on the practice and their model. Yes?
To that point, speaking of the microphone.
Can you? Oh, okay.
We need another one of these.
I know. Thank you very much.
Okay, just to bring up a point about the retainer and that in the old days, 10 years, 20 years, 30 years ago, financial advisors would put on workshops and show how great they are and how smart they are and they do better than everything else. And they might charge a fee of $500 or $2,000 to do a financial plan. But their goal was not just to earn that fee, but to turn around, do a plan that was swayed towards why you need to invest in limited partnerships. And back in the older days, you could do limited partnerships that gave you substantial tax credits or tax deductions. So if a financial advisor says, I'm going to be your advisor, charge you $2,000, and the plan calls for you to get a mortgage on your house so you could buy $100,000 worth of some big leverage real estate deal, then when the government eliminated those deductions, you had to pay back the taxes, the limited partnership failed, and you have all kinds of problems. So if you have a retainer basis, make sure that person is only fee-based and has nothing to do with selling investments or anything, because this is the way they got people to invest years ago, and it didn't turn out so great. But the retainer is good for short term, and then in asset management, the partnership with the person that you're working with has more of a long-term objective.
Yeah.
It's good.
And so one thing I wanted to mention there is sort of the idea there's commissions, sales that people can make money off, and then there's these two terms. You'll hear fee-based and fee-only. So it's very important to understand the distinction between those two. Fee-only means that there is no part of the practice in which commissions are charged, or there's no legacy people in there that are paying commissions. If you see fee-based, that is going to be something that says they both do fee advice and they may sell commissions, or in some cases, there's legacy business that they can't get rid of or they can't convert to fee-only for some reason, so they have to hold their licenses and carry these tiny little bits of commission, leftover commission income. So just because it's fee-based versus fee-only doesn't necessarily mean that they're selling commission products, but it does mean that they have the ability to most of the time. And then obviously you'll have commissions as well. So just a little bit of language. Now, there's the last one, which is the one we talk about, assets under management fee. So this is increasingly common, although now I see a lot of flat fee advisors are popping up as well, because there's just some argument for value as well. But assets under management has become increasingly common, an increasingly common compensation structure. So the AUM fee model is where the client is charged a percentage fee on all the assets under management, or sometimes assets under advisement, which is essentially what they're giving advice on, versus assets under management are what are actually held at the firm or traded by the firm. So generally this will include all the assets held at the firm. That'll be your assets under management. But say you've got, I don't know, you've got a big amount of assets over here, but then you also have a giant 401k that you want ongoing advice on. They might include that as part of the assets, and the percentage might be based on that total combination of assets rather than just what's held. So understand kind of the difference between the AUM, which is the assets under management, which is what they have control over, versus assets under advisement, which is everything they give advice on. So as an example, about 1% is a super common assets under management or assets under advisement fee. So if you've got $1 million with an advisor charging 1%, they'll collect $10,000 per year. So this can be charged monthly, quarterly, or annually, and it can be deducted from the brokerage account, charged to you as a fee that can be paid in a standard way. Now, there's one clever little thing that's nice about getting fees charged from your investment account. And that's when it comes to tax-deferred accounts. Think about this. If the fee comes out of the tax-deferred account, you don't have to distribute that money and pay taxes on it. It comes out of the account before you pay taxes. So if you put the money in there and deducted it, now somebody's managing that tax-deferred account, and instead of withdrawing that money and then losing 25 or 30% to taxes, it goes straight to the person you were going to pay anyway. That is technically a little bit more tax efficient than withdrawing it and paying a flat fee. So even if you're paying a flat fee, if they're able to deduct it from a tax deferred account, that can actually save you a little teeny tiny bit in tax dollars if you compare it to having to withdraw and then pay with something like a credit card. So that's just something, a little cool extra benefit for having management of tax deferred accounts. So no matter what path you end up choosing, trying to determine how the compensation method could affect the type of service you get provided and whether certain solutions are biased because of commission, hours of service, or whatnot. You might, if you're on an hourly basis, check and see if the person is starting to talk particularly slow and take a lot of time in your meetings and want to get you back in and now you can do it next time, stretching things out because, okay, maybe that's not the most beneficial practice in the world. And the one conflict of interest for assets under management models is they want to get as much of your money on platform as possible. Whether you think that's a real conflict or not is up to you, but that's the thing that they'll be motivated to do, is to bring assets on platform and manage them all together. There are benefits to that, such as they can more easily see the overall, structure of your plan, but obviously you pay fees on the money that's there. So just think about what works for you. No one compensation structure is inherently bad in and of itself. It's how the person behaves with it that's important. There are plenty of commission professionals that are great. They're super reliable, they're honest, they'll only sell you what you need, and they'll get you the lowest commission product possible. But human nature is to be greedy. So understanding that certain types of pay are way more biased towards that greed is important. So just understand how it works and understand why they're choosing what they're choosing and all that sort of stuff. Now, be willing to pay those that you know you can trust, but be wary of the people you put your trust in. It's important to understand who you're trusting and how you can trust them and why you trust them. And then if you do, it's okay to either pay the normal fee, pay a little bit extra for something premium, or even just pay an emotional premium for somebody that you really like. Like, there's nothing wrong with that. I would do that with things, whether it comes to taxes or estate planning or even just different restaurants that you like. There are reasons that you'll go different places because the experience is better or the service is better or it's just where you want to be. So understanding that the money is really important, but it's not always the thing that should determine exactly where you go. If I'm comparing somebody who charges 1.1% to somebody who charges 0.5, if I know that 1.1 is going to take care of me and is going to make me feel confident in what's going to work and the math still checks out, I'm okay paying that unless I know for some reason the 0.5 is enough for me, that does it for me, and the lower level of service doesn't bother me. So it's really just like, what do you feel? What makes you feel happy and what makes you feel comfortable and confident about what's going forward? Finance is an incredibly complicated industry, and like any other profession, we have our fair share of bad actors in the space, ranging from high-pressure salespeople who focus on commissions, all the way to outright scammers who are going to take your money and run. We've got our fair share of stories. I have somebody that used to be a best friend of mine back in the grade school days, and he got all of his friends and family to invest with this woman that promised to trade options and guarantee a 10% monthly distribution. And like, it seems so incredibly obvious, right? Like, it feels so obvious because here's the thing is, like, I think she started out as not necessarily wanting to be a scammer, but just being so overconfident in her own abilities because it was one of these years where all that happened was the stock market went up. So she bought call options and made tons of money with barely any effort at all. It was like, oh, well, I could just do this professionally and whatever the case may be. And so all this money came in and she had like 1 or 2 good months. And then as soon as things started going sour and she started losing money, she just started taking the new investor money and paying out the old investors until all the money dried up. And then eventually the SEC froze all of her assets because clearly people were not getting their distributions. She was avoiding and avoiding and avoiding. I remember always asking him, so how's it going? Are you like getting your stuff? He's like, oh no, we just gotta wait like another month or we gotta wait another 3 months. I'm like, you understand what's happening here, right? So it's just, you gotta understand when things are too good to be true. And even if you wanna try it, little tiny percents. And if it works out great for you and you found the next big thing and now this person takes you to the stratosphere, fine. But understand how to balance your risk and how to know when things sound too good to be true. Guarantees, unless you're paying giant fees for it in some insurance product or annuity product, you're gonna give up something else for it. or it just doesn't exist in the first place. So just be very, very careful when you're going through those different avenues. So when you're choosing a financial professional, it's crucial to feel confident in your choice so that you can work together on a successful strategy. That's where most of it comes from. It's not the fees, it's not all this other stuff. It's the confidence and the communication between the two of you to work together to create a strategy that works. So what should we look for? Now, what's interesting is you'll see a couple of these are actually mostly personality based, because that's really, really, really important. One is a willingness to meet you where you are and create a mutual understanding. It's like I talked about before with suitability. If they can't explain to you why we're doing something, that's kind of a red flag to me. If you can't tell me why it's a good reason for me to do this and have me understand why we're going in the direction we are, I'm not going to do that. Patience. If you're rushed into a decision without a good reason, like if it's the end of tax season and you need to do something to get a deduction, fine. But if there's no real reason to get rushed into something, to get rushed into a new investment product, to get rushed into a new structure, I don't like that. That's one of the number one things that we always get in our training when it comes to protecting our clients from fraud is that patience. Rush, being rushed on something, being really, really pushed to do it now, today, now, don't think, do it now. Red flag number one. You want to make sure that there is a willingness for patience, and that if something is time sensitive, it's time sensitive because you're going to lose a benefit or whatever it is, but it makes sense and you can track it down to a real law or benefit or whatever the case may be. Now, competence. Your advisor should also inspire confidence in their ability and be willing to admit their limits of expertise. Because that's the thing. It's okay if they don't know everything, but if they tell you that and are willing to either help you find the solution through their own research, refer you to somebody who is better suited for that, we're good with that. One of the main things, especially when it comes to one of the designations we'll talk about, which is the Certified Financial Planner designation, one of the requirements for people that hold that is to be willing to defer expertise when they're not the person that's the right one to handle it. So they have to be willing to hand off to a CPA. They have to be willing to hand off to an attorney when it's not their position to make the best call or do the best strategy. So there's a couple professional certifications and designations that can help you weed through some choices, as listed here. Now, we'll get into those a little bit more specifically in a second, but Chartered Financial Consultant, Certified Financial Planner, Chartered Financial Analyst, and Chartered Life Underwriter. All of these go over different expertises within the industry or general knowledge, so they can kind of help you. If you see a couple letters next to somebody's name on a business card, you could look that up and see what kind of training they went through to help you get an idea of the stuff that the education that they've gone through to get to where they are. So one thing you'll want to make sure you do, and this is really easy, just check their background. There's a website called BrokerCheck, which is brokercheck.finra.org. Now, I know it says broker, but you can do this for investment advisors as well. And it lets you check on a professional's registration status, disciplinary history, licenses, and the different brokerage and advisory firms where they've worked, been contracted at, all those sorts of things. The two most common licenses that financial professionals will hold are a Series 7, which is the one that allows professionals to sell securities products for a commission, as well as Series 65, which is what allows somebody to provide investment advice and charge a fee for doing so. This is what BrokerCheck looks like. You'll just put in the name of your professional right here, or if you feel like it, you could put their firm name here if you wanted to search for a firm, and then you just click search and you'll get a bunch of options. If your advisor has a very common name, you might want to fill out all of those fields so you're not weeding through 20 different search options. Now, that's a good question. What do you think?
It might merge with the SEC, but FINRA and SEC are quite large.
Yeah. Mm-hmm. Yeah, those two agencies are where the investment advisors and brokers, they register their companies. So I imagine if that were to get, brought away, that would create a lot of turbulence in the financial services industry.
FINRA regulates the broker dealers or anybody that's earning a commission, then the SEC manages the fee-based advice. But if they did merge it, I don't know that it would be a bad thing because they're always dealing against each other on the regulations and confuse the heck out of us.
Yeah. Okay, so let's talk about the firm a little bit, the firm structure. There's basically these three different firm types that you'll see commonly. First of all is what's called the registered investment advisor. So this is the legal entity that registers either with their local state or the Securities Exchange Commission based on the size of the firm. If the firm has less than $100 million in assets, usually it'll just register with their home state or the states that they do business in. And if they're over that number, they'll register with the Securities Exchange Commission. So an individual will be an investment advisor representative. So basically this is the person who acts on behalf of the company in order to provide investment advice. So they act on behalf of that, what's called RIA, to provide advice. And generally, if it's just an RIA, and that's their only legal structure, they provide fee-only advice because a registered investment advisor does not buy and sell products for commission. That's where the broker-dealer comes in. The broker-dealer is a different legal entity that registers with the SEC, and the individual will instead be called an agent of the broker-dealer and conduct commissions-based business on the broker-dealer's behalf. Those two words, broker and dealer, are basically, they mean two different things, but usually it's one company. A broker is buying and selling assets sort of as a representative and connecting you to another trader or whoever is the other side of the trade. And then a dealer buys and sells out of their own inventory of assets. So usually those are just the same company. You're not going to see a broker over here and a dealer over there. It'll just be a broker-dealer. Then you've got a hybrid. So usually this will just be called hybrid RIA because usually it's a registered investment advisor with a broker-dealer arm to help support different types of business. So this is a combination of both of those. Advisors might be duly registered with both sides, meaning that they're both an investment advisor representative and an agent of the broker-dealer, which basically allows them to use either fee-based products and just charge based on advice, or to buy and sell commission products depending on what solution is best. Or if there's a solution that just doesn't exist in the fee-based world, they can reach to the commission product world and they can potentially offer that solution as well. So a lot of the times, especially with big firms, those will be hybrids, something like an LPL or an Osaic Wealth, or any really big names will usually be hybrid broker-dealer registered investment advisor because they'll have both types of service, both types of solutions operating in there. Usually RIA only entities are a bit smaller because once you get big enough, usually you need to have that broker-dealer arm to provide all the types of service. So an advisor might also represent an insurance company, selling products like whole or universal life insurance or fixed, indexed, or variable annuities. Generally, the fees that are baked into products like this outweigh a lot of their benefits for the average person, but in some specific use cases, they can be applicable. So a lot of the times, like, if they talk about tax deferral or all this other sorts of stuff, usually that only becomes super beneficial when you've exhausted all the other options that are available to you at little to no fees. So like, especially if we've got younger people who are accumulating, it's going to be way better for them to just be investing in a 401k with low fees, investing in their Roth IRAs, buying inexpensive target date funds or mutual funds or ETFs or whatever, than putting all that money into high cost, high surrender penalty variable annuities and all this sort of extra stuff. High net worth individuals tend to benefit more from services like this because there's some advanced tools and some extra things that can be helpful, but usually they're not super beneficial for us regular folk. Pure insurance products can be sold without a securities license because there's no investment piece to it. However, the products that do have an investment piece, generally you'll see the word variable in the name. That requires an agent to hold a securities license, and they're held to some stronger standards when it comes to selling that. So you might see a difference with an indexed annuity. They might get a little bit more generous with their speaking versus a variable annuity. They might be a little bit more conservative and a little more realistic with the way that they project things to you. So just something to consider. Each structure and arrangement, all of these things, they have their place in the industry. Like the compensation structures, like commission versus AUM versus flat fee, nothing is necessarily good or bad in and of itself. It's all about how it works, if it's the best solution for you, and just how this fits into your overall picture. We might caution wariness against high fee insurance products and annuities, but it's up to you to do the due diligence on whether the product works for you or not. Or it's also not for you to simply trust our opinions or the opinions of an excited salesperson. You know, somebody might have some really, really good presentations to show you, and that's just because that's what their job is. And we're always going to try and impart our best knowledge onto you to make the decision for yourself. But understand that this industry is complicated. Sometimes I say things that aren't quite perfectly accurate. Sometimes I make mistakes, but we always try our best. But it's still going to be up to you to vet everything that you do for yourself and make the absolute best decision, or trust a professional to do it for you. So the most important thing is knowing that your professional is genuinely acting in your best interest, no matter what the pay structure is. I don't care if it's a broker or an advisor or a life insurance agent, doesn't matter to me. If they're acting in your best interests, all good in my book. Use your common sense to sniff out red flags and get a second opinion if you're still uncertain about stuff. Just really make sure that you're, cross-referencing. So there's a handful of industry designations and certifications that can help demonstrate a professional's knowledge, and I'll go through a couple of them right now really quickly. First of all is the Certified Financial Planner, or the CFP certification. So that's awarded to professionals who have experience in the industry, who have undergone rigorous education and agree to some ethical standards set forth by the CFP board. The candidates also have to have a bachelor's degree, although oddly enough, it doesn't matter at all what industry the degree's in. You could do dance if you wanted to, and it would still count. But they also have to pass a really intense exam in order to earn the marks. It's like a 130 question exam or something like that, and it takes a few hours, and it's pretty hard, I'll say that from experience. So the duties of a CFP professional, there's a lot of them. We won't go through every single thing here, but they've got a lot of duties that they have to follow at all times. They have certain duties that they have to follow when they provide financial advice, and even more when they provide financial planning. And all these things are determined by the CFP board, which is an independent group that hands out this designation, and they take all this incredibly seriously. They really take serious any crimes, especially high-level felonies and stuff like that, or anything to do with financial services or securities. You will get your marks taken away from you like that. So pretty good one. There's also Chartered Financial Consultant, which is kind of like the baby brother of the CFP. This is from the American College of Financial Services, which they actually have an education course that fulfills education requirements for the CFP, and it also fulfills education requirements for Chartered Financial Consultant. So the difference, there's only a couple little differences. The education is pretty much the same, except this one doesn't require a degree, and it doesn't have one big giant exam at the end. It's just little exams for each section of knowledge. And it also doesn't have an experience requirement nearly as rigorous as the CFP. But it goes through all of the same learning topics. It just doesn't make you remember all of that for one big giant test at the end and have a bachelor's degree. So they're pretty similar, but it's really just the baby brother of the CFP. Now the CFA, that's something you're probably not going to see a lot with advisors, but if you start to step up into the higher ranks of, fund managers and investment analytics and all that sort of stuff, the CFA designation is arguably the most intensive letter combination a financial professional can have next to their name. Usually they work, like I said, in high-level investment banking positions, often being a major part of the investment team of a fund or a big strategist. Like if you've got, some offloaded, what's the word I'm looking for? But like if a financial professional has an outside strategist manage their portfolios for them, that's where you're going to have a lot of CFAs working at. The CFA is considered the gold standard in the field of investment analytics. They're the ones that, they're looking at the market every single day. They're looking at all the numbers. They're reading all of the documents, everything that is super intensive. That's what CFAs have learned to do. Instead of taking one really brutal exam like the CFP, they get to take 3 different ones back to back, and it's a lot. So let's talk about advisor practices and things you want to get away from. First of all, unlicensed activity. Sounds pretty obvious, but make sure that your professionals are properly registered and licensed, and don't fall victim to people pretending to be professionals. One interesting trend, which if you're on the internet a lot, if you're on YouTube, especially if you look at finance related topics, you'll just see these like comment threads of really obvious like AI generated conversations where they're talking about like these really good investment professionals. And it's like, it'll just be like this weird, really obvious conversation. Like, in this day and age, it's so important to get good returns for your financial future. Yeah, that's why I worked with Bob the Builder, or some ridiculous thing that just goes down. You Google it and you're like, oh, that's a real person because they referenced a real professional. Then you go back to the thread and it says, message them on Telegram or WhatsApp or something. And you go, okay, obviously that's not the way you want to go. So just like double check everything and communicate through proper communication channels. Unregistered securities. This one's a little bit further down, but also keep your assets in liquid and transparent investments for the vast majority of your funds. Don't get stuck in sketchy limited partnerships, penny stocks, or tiny crypto coins. That's not to say that all of these things are horrible. It's just that if you have a nest egg, that's probably not where you should put the majority of your funds. Crypto can have a place in your portfolio. Penny stocks could have a place in your portfolio. Limited partnerships could have a place in your portfolio. But just because they have these high returns or whatever it is, it doesn't mean that it's the best thing for you across the board, especially with nest egg investments. We want transparency, liquidity, so we can access funds when we need to. And locking things up in hard to get to funds is not super suitable for the majority of us. And that takes me to the next thing, unsuitable recommendations. Know that not every single product is going to be the best one for you, and you should at least be able to understand the basics of the investments you hold. You should have a fundamental idea of why what you have works for you. And then tax-preferred redundancy is just something interesting where, like, you don't want to see municipal bonds in an IRA unless they're taxable. You don't want to have, different types of products that are doubling up on benefits that end up mathematically being worse for you. We're not seeing that a whole lot, but sometimes it happens, and it's just something to look out for. The other thing in terms of advisor practices is account churning. So if they make money based on trades, you don't want to see back-to-back trades the whole time that just charge you a ton of money. Or if you're obligated to pay for trading fees and they're trading back and forth constantly every single day all the time and just reducing the value of your account to fees, that's not super great. But then on the other side of that, there's reverse churning. So this is one of the other possible downsides, depending on the behavior of the professional with an AUM model, is if they put you in a portfolio and then they don't touch it for 5 years and they don't talk to you at all through the year, they're not doing anything. And to us, we consider that to be reverse churning because they're doing no activity to make sure it stays with your goals. They're not talking to you, and they just hope that you never call. So if it's difficult to get in touch with your professional, yes, it is. In fact, I've like talked with prospects before and, to be honest with you, gotten clients because their advisor avoided them. And they like literally would not answer calls. That was like my first client. They were talking about, we've been trying to get in contact with him for like 6 months. Every time we call, he's on vacation. And it's just like, let's be real here. Like, you got to be at least a little bit responsive. So,
I get notices from our staff, and then Nash will tell me, or I'll tell him, we need to look at a portfolio, because if it's situated really nicely, but we haven't done any activity within 24 months to 12 months,
12 months.
Then our regulators, the home office, will come down on us and say, what's going on? You're charging a fee and you're not doing anything. So then we have to justify, no, we talked to the client, these are still appropriate. And that's why you want to only deal with somebody that has a home office like a Fidelity, or ours is Osaic. They have 8,500 advisors, because when you see these things on these little shows where somebody goes with another broker and spends all their money, and they had an account at Schwab's not responsible for that unless that's an advisor that uses Schwab's advisory services and supervision. So obviously, and a lot of the stuff that we're bringing up here, you guys already would know or do, but it's for you to pass on to family members or friends. And whether you manage money or not, they may go astray. So we want you to go out and further this education.
Yeah. And then the other couple things, unauthorized transfer of assets. absolutely never, ever, ever should money move without you knowing about it or specifically allowing it to happen. You shouldn't see money moving between accounts with no express consent or no previously agreed upon plan. And same thing, like that comes to us, like I can't do any movements unless I hear the client say it to me with their voice. Emails don't work, text messages don't work. I gotta hear and verify the person I'm talking to, because that's a huge part. Again, that's part of our fraud training, is we gotta make sure that we're verifying who we're talking to. And that's the same thing where time pressure is important for you to not get sold into something that's unsuitable. Time pressure is important to me so that I can go, hold on a second, is this who I'm really talking to, so that when I follow instructions, I'm not transferring it out to somebody who's not really the client. So a lot of these go back and forth. Unusually high fees. Again, like I mentioned before, it's one thing to pay a premium fee for a higher service or somebody you trust or somebody you like, but it is a good idea to at least understand the landscape of fees that you're in, to understand where do I sit relative to this and how much of this extra fee do I feel like is worth it to give to my advisor that I like and trust, or whatever the case may be. So, deciding what's right for you. The time you have left is your most valuable asset. Spend it in a way you enjoy. The more complex your situation is, the more you will benefit from the advice of a professional. Ultimately, there's no perfect answer for every single person. Go the route that gives you the freedom to live the life that you want to live. If control is important to you, maintain the control. If peace of mind is important to you, get it through a way that's comfortable. Whatever it is that you want, understand that what you want is most important. And the numbers can be skewed a little bit one way or the other. But if you're comfortable and you feel good and you feel confident, that's the number one thing that we want. We want you to succeed and be happy. That's what we really want. Now, really quickly, before we wrap up, I know we're a couple minutes extra, but it's okay. I just want to show you how to use BrokerCheck. And in fact, I'll show you it on me. So we'll search me up and I'll show you exactly what you'll see. So you'll see here, your different results will end up. Obviously, there's no other advisors with my name, so that's nice. You won't get me confused with anybody. But if you'll see something here, disclosures. So usually that happens if either a firm or a professional needs to disclose something publicly because it's either a conflict, a complaint, or anything that's either sort of neutral but needs to be said, or negative and needs to be clearly defined to the public. Then you've got your years of experience. So the reason that this only says 2 is because it's counting from when I was actually registered as an advisor. It doesn't count like my administrative or support experience at all. So that's just a little thing that you can also understand. But you'll see here also a CRD number. That's like the easiest specific way to find your professional. If there's like a ton of people with the same name, if you go, can I get your CRD number? You can plug that in and find them very quickly. You can see over on the side which firm that I'm registered with and the address of our office. You can see how many years of experience, how many firms, the amount of licenses and the FINRA registrations. You can see where the professional has worked. So you can see, like I was mentioning that hybrid structure before, where there's both an RIA and a broker-dealer. You can see that I was registered with both sides of Securities America here, the investment advisor on this side and the broker-dealer on that side. And then you'll see the same thing up here for the investment advisor of Osaic and the broker-dealer of Osaic as well.
But they're all the same firm. Osaic bought out or took over Securities America.
Yes. And then you'll see things like the state registrations, FINRA registrations, and the licenses that are held. So that's just kind of a nice thing for you to understand how to use decently, and great, easy way to look up any of your professionals. And then there's also a couple different examples of fines that we can look at. So this one's interesting. I just wanted to show you examples of fines and how they don't necessarily mean that this whole firm is horrible. It's just, here's how you can kind of get some ideas on how to see fines, how to, evaluate them and get an idea of what they mean. Because obviously, if you get a letter like this, if you're with LPL and you see they got fined almost $20 million, that sounds pretty horrible. And then you think about scale and how much money there actually is, and maybe it sort of downplays it, but it's good to understand context. So basically the thing here was, LPL paid an $18 million settlement because they had an anti-money laundering program, which is something that every advisor and broker-dealer has to have to make sure that we're not, funding terrorists. It's pretty important. So it apparently failed to vet customers properly and didn't close accounts that were flagged as high risk. So that's one thing that's really important is if you see a high risk account, that could be a restricted country like Russia, or one thing that's a little controversial and interesting is like the cannabis industry. It's a really, really big industry and legal state in a lot of states, but it's still not legal at the federal level. So we can't serve those customers. If you go make $10 million in the cannabis industry and go, okay, great, I had a big windfall, can you invest it for me? I can't, I'm not allowed to. And that's, just because of federal laws. So that's one thing that, they had a policy, but you can look at this as kind of a good thing too. It means that the SEC found them and said, you got to tighten that up. So now their policy is going to be better moving forward. So you can see it as a negative and a positive. And then let's go to this one too. And now we had another one where state regulators fined Edward Jones for overcharging on mutual funds. This one was really interesting because essentially what happened was you would get sold a mutual fund for a commission, right? We'd have that upfront A-share commission. And then there's like a certain period of time to where the commission kind of goes away, and then you could roll them into a managed account where they pay that AUM fee. And it's like, okay, sure. But they would move them over from those mutual funds before the fee kind of paid itself off. And they would offer a little bit of a rebate, but not enough to cover the extra fees. So it would be like, okay, I pay you 6% for the commission, and now you're like, okay, but we want to actually move you over to the managed model. But we'll rebate you 3%, and they move them over, and now they charge 1% in perpetuity, and they kept that little 3% that they didn't end up rebating. So it was just this extra overcharge that never needed to happen. That was just because they put them in here, they keep them there for a year or two, and they go, we're going to give you a little bit of money back if you roll over here. But then mathematically, they're walking away with an extra few percent for every single transaction, and then getting them to an AUM model. Yeah, I know, and it's a great question. I don't know how they found it. I imagine that there would be a lot of customer complaints because there are a lot of clients that will do the math. Like they will sit there and they will do the math and be like, what is this number right here? So I'm going to manage.
The regulators audit them every year, every 2 years. They'll go through their home office and they'll look at every account. And then the RIA or the broker dealer will send somebody to all the small offices. So we just had an audit recently, and they'll go through all your files looking for anything suspicious at all. And the way that the FINRA and SEC make money is to charge fines. So if they find something off slightly, just bookkeeping, record keeping, the bigger the company, the bigger the fine. So a small company wouldn't pay that much. Schwab, I think since 2000 has paid out $1 billion with a B in fines, but it doesn't mean they're dishonest. They've got so many advisors, some of them got away from them and maybe did something wrong, took advantage of something. Our home office got fined a small fee for not tracking text messages.
Mm-hmm. Yeah, because basically you can't just just do text between clients. That has to be through approved and certain, it has to be held to a certain standard and record keeping, lots of extra stuff. So a lot, there was like 15 to 16 different firms that got swept up in that lawsuit. Yeah. Ours being one of them.
And had much bigger fines. Yeah. So these regulators are great. So we hope that if the most they firm put them together, but we really need them to keep honest people honest.
Definitely. Okay. Well,
awesome.
That brings us to the end of our class. I know it's so sad, but we'll be back next semester and every semester going forward until either I keel over or they kick us out of here. So you can definitely see us again. Make sure we'll be working on our website, make it the best place for you to go. But, really hope that you guys have a good summer. Thank you for coming. Appreciate it a lot.